you just flesh out more of what you mean by this irrational extrapolation? And I think I've heard you say before that there are kind of like 3 examples, and you alluded to them before, but perhaps you can just run through them and what you're looking for.
Yeah, it's as simple as, okay, you've got, let's talk a specific example. So we own Honda in our portfolios today. So, on 0.7 of book, P of 7, dividend yield of 5, roughly.
Right.
So Honda, people think it's an auto OEM.
Mm-hmm.
Its largest profit pool today is motorcycles.
Right.
And it's not the Honda road bike that you might see out there on the street.
Mm-hmm.
It's actually scooters and small scooters and motorcycles in emerging markets, where it's the preeminent, dominant, manufacturer and brand.
Mm-hmm.
That is an incredibly attractive business. High margin, high growth, and massive barriers to entry.
Mm-hmm.
The value of that alone accounts for all of Honda's market cap. You're not paying anything for the car business. Now why? Why is that? I'd argue it's because the market is so cyclically extrapolating that you've got weak EM growth, weak global growth. Okay, yep, you do. So tick.
Mm-hmm.
Now, will it always be weak? That's where I'd argue the market's now being a bit irrational.
Mm-hmm.
Growth is cyclical. Economic growth is cyclical. It will recover at some point. The bigger concern for the market is structural changes that are happening in autos. The transition, how capital intensive is the transition to EV going to be? Will autonomous driving, ride share, what do these things mean for auto demand? So that structural change, does it make the average auto OEM a value trap? Now, we think that's irrational to the extent that it's too simplistic. Yes, there'll be winners and losers, but the most important thing is to back the winner. And I think in the case of Honda, we think it's dealing with those structural challenges in a very rational way. Now, the third aspect we would argue of changes that can often lead to a irrationality we would just describe as broader macro socioeconomic changes. It's in the case of Honda, it's hard to be specific on anything I can think of at the moment. Mm-hmm. But you could take other industries where, you can sort of see it happening, I think, in a good example, I think, in regards to Honda is simply what's going on in Japan in a positive way in regards to governance and focusing, the government through through the GPIF, which is the government pension plan, and also just through through policy, just putting more pressure on corporates to be shareholder friendly.
Okay.
That's why there's more activism taking place in Japan, and Honda is vulnerable. I mean, they should be paying out, should be being more aggressive on buybacks. Got a very cheap, attractively valued equity. They should be buying back. They've got surplus capital. That's broader positive change, which we think the market's not recognising, and hence is being irrational.
Mm-hmm. That was a phrase that stuck with me, irrational extrapolation. But another, I suppose, neat, concept that you bring to the table, and we spoke briefly off air about this, is the way you structure your teams and ideas. So you've spoken about the quant filters, how that identifies opportunities and gives you particular insights that probably many other investors wouldn't have. But the way you invest and structure your team is such that you invest in clusters, or you have particular clusters, might be for a sector or region. Can you explain what you're trying to do with the clusters and how that benefits your process?
Yeah, look, it's two benefits, and the goal is basically, we think if we concentrate on industries, basically lead with industry expertise, and each of the teams is on average 4 2 senior analysts plus a sector head, a senior analyst, and a couple of associates. So we've got the horsepower in those teams, and they're really, the way we've designed remuneration is to encourage collaboration.
Okay.
So they operate as teams, and they're effectively building shadow portfolios as teams of their best ideas, and they're clustering within those industry shadows. And they've got use of the quant tools to see where they've got correlation, which they may not know about, and thinking about how they need to manage that. So it's all what we're doing at the head portfolio is really just bringing those insights that are, and from the models at each of the industry teams. Look, that process is about what we want is from that industry insight. It's then saying, okay, this is interesting. What are the investment case candidates? And what we find is, there'll typically be more than one. There'll be, and there may be, in fact, a long and a short, or a number of longs and a number of shorts. And it's taking the best of those ideas as a part of that process. In our experience, if every piece of research is just to stand out, if you design a structure which just leads to single stock notes, stock meetings around single stock ideas, you're just leaving a lot on the table. And you may be making errors of judgment because you haven't started broader. The industry research is really long term, and we unbundle that from the investment case, and we allow the investment teams to do that slow thinking, to go to conferences, to think really long term around where the industry is going and who the relative winners, losers are. Because the way the market is, the market's clearly operating on that time horizon, because it's celebrating. The winners are typically, people are willing to put them on the high multiple. Now, not all of those companies will prove to be winners. I am absolutely certain, because I think there's a fair amount of hype
for sure
around disruption. But we have to think on that time horizon. When you're thinking about US retail, it must start with a view on Amazon. You may not end up wanting to buy it, but if you're going to buy someone, and you potentially want to be buying a company that is not a part of its, it's not in its competitive sort of crosshairs.
For sure.
So we think lead with industry, investment cases will follow from that. That's the industry research is the slow thinking. The investment cases tends to be the more, you need to be more market sensitive, i.e. you need to be ready to pull the trigger when the market gives you the opportunity. So the investment case, it's not that when we say fast thinking as in it has to be rushed, not in that sense, in the sense that will be more time definite. So if a certain industry is becoming cheap, and you might want to accelerate the industry research and get the investment cases done. So you're ready to act, at the cyclical low point, or when the structural concerns are most pronounced. I think interesting. If you think about the big drug stocks today, it's the one part of healthcare that hasn't been significantly re-rated.
Okay.
And for good reason. The structural patent cliff, political focus on drug prices. So it's probably worth looking at it now, right, to test whether that view is, whether the general view and the general concerns around structural pressure is right in every case. Because you'll probably find some interesting longs and shorts.